How central banks can increase or decrease money supply. Hi guys, how's it going? In today's video, we're going to be reading an article, in this case about the economics. So the main topic is about how the central bank works and how can increase or decrease uh, the supply of money in the market deliberately. So let's go for it. This article is by Chris Gallant. The Fed's monetary policy tools. Central banks use several different tools to increase or decrease the amount of money in circulation, also known as the money supply. While the Federal Reserve Board, commonly known as the Fed, could introduce more currency at its discretion to increase the amount of money in the economy, this measure is not used in the United States. The Federal Reserve Board of Governors is the governing body that manages the Fed, and it's required by Congress to achieve the goals of maximum employment, stable prices, and moderate long-term interest rates. Thus, it is responsible for controlling inflation and managing both short-term and long-term interest rates. Using its monetary policy tools, it achieves its goals by controlling how much money circulates throughout the economy. Uh, to, to understand a little bit about what this article is about, we must understand some key takeaways. For example, one of those, and well, we have like a list of bullet points here. The central banks have a wide array of tools of at their disposal to influence economies. These tools focus on interest rates and the amount of circulating currency. The Fed targets a federal funds rate range, which influences the rates that banks charge on loans. The Fed can alter the interest rate it pays on the funds that banks hold as reserve balances. Besides, it can also modify its overnight repo rate and its discount rate to affect financial institution lending and borrowing. Altering these rates affects the Fed funds rate, which in turn influences broader lending and spending and ultimately the money supply. Federal funds target rate range. The Fed, about this topic, influences interest rates by monitoring and changing the target range for the federal funds rate, the overnight rate at which banks lend reserves to each other. It usually sets a 25 basis point range, such as 5.25% to 5.50%, which helps maintain a desirable effective federal funds rate. The acronym of this is EFFR. The EFFR is a volume weight median of loans between these depository institutions. This rate influences all other rates, including those for bank loans and credit card balances. As a result, it also influences the spending and saving, which affects the amount of money circulating throughout the economy. Interest on reserve balances. In the past, the Fed influence. Again, this part of science is really important to notice. Interest on reserve balances. In the past, the Fed influenced the money supply by modifying reserve requirements. This refers to the amount of funds banks are required to hold against deposits in bank accounts. The Fed no longer requires banks to hold reserves. Its primary tool is now interest on reserve balance, IORB, by paying interests on any reserves that banks keep. It establishes a certain level of support for rates. This keeps the federal funds rate from dropping too far below it. IORB influences banks to keep money in reserve or deplete their reserves based on demand for loans and the level of rates, adding or subtracting to the supply of circulating money. The discount rate. Banks can borrow money from the Fed using a lending program it calls the discount window. The interest rate set for these loans helps set the top number, the ceiling, for the federal funds rate target range. These loans are short-term up to 90 days, for example. By lowering or rising the discount rate that banks pay on short-term loans from the Federal Reserve Bank, the Fed effectively increases or decreases the liquidity of the banking system. Of the banking system. Let me see. Oh, let me see which was the last part we read here. Next topic of this article: overnight reverse repurchase agreements. The Federal Reserve conducts overnight reverse repurchase on RRP agreements, in which it sells a security to an institution, then buys it back the next day for more money. The interest rate used for on RRPs helps the Fed set the lower rate, the floor, of its Fed funds target range. These reverse repos subtract money from reverses, in essence, taking money out of circulation. Open market operations. In open market operations, the Fed purchases and sells security issued by the US government, such as treasuries, which can affect the amount of money in circulation. Open market operations once played a major role in the implementation of Fed's monetary policy. Currently, they are conducted only to help the central bank maintain the ample level of reserve it believes is needed to continue to administer the aforementioned rates to influence the effective federal funds rate. Fast fact: before 2008, the Fed's primary tool for affecting the money supply was open market operations. If it wanted to increase the money supply, it bought government securities. This supplied cash to the banks with which it transacted, and that increased the money supply. Conversely, if the Fed wanted to decrease the money supply, it sold securities from its account. Doing so removed cash from financial institutions and the funds in circulation. What is the central bank of the United States? The Federal Reserve is the central bank of the United States. Broadly, the Fed's job is to safeguard the effective operation of the US economy and, by doing so, the public interest. Why would the Fed increase interest rates? In the economy is overheating and the rate of inflation is rising along with prices consumers pay for all kinds of products. The Fed will step in to cool things down by raising interest rates. When rates are raised, borrowing becomes more expensive, so fewer people and businesses engage in it. That process tends to slow spending and other economic activity, which in turn reduces the inflation rate. What is US monetary policy? It is the mandate provided to the Fed by the US Congress to support maximum employment, stable prices, and moderate long term interest rates. The Fed uses its monetary policy tools to implement that policy. The bottom line: the US Central Bank has variety has a variety of monetary policy. I'm gonna repeat this part since it's completely really important and I feel we must put like more emphasis on this one. The bottom line about this, the US Central Bank has a variety of monetary policy tools at its disposal to implement monetary policy, affect the Fed funds rate, and alter our nation's money supply. Currently, the three ways it does this are modifying the interest rate that it pays on banks' reserve balances, altering the discount rate it charges banks that wish to borrow from it, adjusting the overnight reverse repo rate it pays to financial institutions for temporary overnight deposits. By increasing or decreasing the money supply, the Fed aims to maintain stable prices, moderate interest rates, as well as to promote maximum employment. And that was the article, guys. Maybe we can do a review as well of this, diving a little bit more deeper about these topics. But as always, I'm gonna put the link of on the description below, so you can read it by yourself and get more direct approach to this source. So until the next one, have a good one. Bye.